Hi, this is Mary Lynn Fayumi, President and CEO of HR Source, and I'm joined today by Allison Bentonville, a CFA and a principal at STRAT. STRAT has been a long-term partner of HR Source. They assist us with our 401k, our reserve fund, and they are a provider partner that we also recommend and refer many of our member organizations to. As you all know, this has been a very challenging time for the world, for the United States, for Illinois, for employers, and we have been working diligently at HR Source to make sure our members have the information, the support, the education, and the resources to navigate through these unprecedented times. You all know that late in March, President Trump signed the CARES Act, which is an 880-page piece of legislation. And organizations have had a real challenging time figuring out how exactly this CARES Act, with its many provisions, applies to them as an organization and what elements of it apply to their staff members. So that is why I called STRAT. And have asked Allison today to give us some assistance in answering some of the tough questions that leaders, managers, and particularly HR professionals are asking us about the CARES Act. So we're going to have a conversation today, and we sure hope that it hits on many of the questions that you have. Again, HR Source as well as STRAT stand ready to help you if we don't get to specific questions you have today. So don't hesitate to reach out, and we'll try to do whatever we can to make sure you get the assistance you need. So with that, Allison, are you ready to go? We'll go ahead and get started.
Yeah, absolutely.
Okay, so first of all, what impact does the CARES Act have on 401k plans?
Yep. So, a couple of important impacts. The biggest one is really expanding the ability for those that are impacted by the virus to take money out of the 401k plan when they maybe otherwise wouldn't be eligible to do so. So, we can touch on some of those details. There's also the ability for those impacted to delay loan repayments if they have a loan outstanding to not repay that in 2020. And then also some ability for those that are required to take minimum distributions this year to delay or defer those distributions.
Got it. So in terms of key provisions, can you tell us a little bit more about the loan and withdrawal?
Again, really intended for those impacted by the virus. So the bill defines qualified individuals as those who have been diagnosed with the virus, who have a spouse or dependent who's been diagnosed with the virus, or who have suffered a financial impact. That would include being quarantined, going through a layoff, furlough, reduced hours, even unable to work due to childcare issues could all be considered financial impacts under the bill. And then a 401k plan can allow a participant to take either a special withdrawal or a special loan. So, under the special withdrawal, a qualified individual can take up to $100,000. There is no early withdrawal penalty. So, unlike a standard hardship distribution, that 10% tax would not apply. And then the distribution can either be repaid to the plan within 3 years, or the participant would need to pay income taxes on the withdrawn amount within 3 years. There's also the loan option, somewhat similar, expanding the ability to access funds in the plan. So this special CARES loan can be for up to $100,000 or 100% of the participant's balance. And then because an impacted individual can delay loan repayments, that means that the special CARES loan doesn't have to start repayments until 2021.
So a lot of HR professionals are reaching out and saying, and sometimes this is the CFO as well, or a president
Mhm.
who is a plan sponsor. Is there something I need to do to change my plan at this time? What actions do organizational leaders, HR professionals, finance folks, what action is necessary on behalf of the employer at this time?
Yeah, that's an important question. So, with respect to these loans and withdrawals, these are not required provisions. So, you don't have to offer them in your plan. What is required, though, is the option for those impacted individuals to delay loan repayments or to defer required minimum distributions. So those aspects are required, and we always recommend touching base with your specific plan administrator if you would like to offer those loan and withdrawal provisions to understand their timeline and process to make those available.
I know this question isn't one that we talked about in advance, but I'm interested to know, are you hearing a lot from employers about wanting to make these provisions available for their team members,
Mhm.
or hesitancy, not understanding the pros and cons? What kind of prudent steps should an organization take to make that decision?
Yeah, good question. So, we are hearing a lot from clients, a lot of questions, but really a range of situations. And we think it's most important that you calibrate the potential offering of these features and the communication of them to your population in your specific situation. Obviously, not every company is impacted by the virus in the same way, and every company has a different corporate culture. We've heard from certainly organizations that are going through layoffs and furloughs that while they don't love the idea of making retirement savings available to employees, they also recognize that people do have near-term financial needs and this is a way they can meet them. We've also talked with clients who really aren't having any business impacts and have transitioned their staff to working from home, and they don't have known issues of the virus within their population. And in those instances, a lot of those clients have chosen not to offer these features at this time, recognizing that as things change throughout the year, these features could potentially be added to address needs. But then other clients have gone ahead and offered them, trusting their employees to make good decisions around using these features, and hopefully weighing short term consequences versus long term outcomes. Of course, an employee's spouse could be impacted by the virus, and the family could be facing a financial situation. So, those are all important considerations, and especially weighed against the fact that these are really liberal withdrawal provisions. This is a this is a self-certification approach, so an employee doesn't have to provide documentation that they are impacted by the virus. So this really is pretty wide open ability for employees to access their 401k funds.
Yeah, and you hit on a number of good points, but one good point is employers are really challenged right now with trying to get documentation even on medical leaves. I mean, the ability of
Mhm.
employees to get the type of documentation that employers so often depend upon to make decisions is not easy to come by these days. So we're finding employers really flex up on their usual requirements and understand that some of this documentation is not going to be forthcoming in the near term, if ever, and they're going to have to just go on good faith and have trust in their employees. I'm wondering, I think you already hit on a lot of the pros and cons, but are there any other pros and cons that the plan sponsor should be considering when trying to make the determination about offering these various options?
Yeah, so a couple other things of note, especially in comparing the loan and the withdrawal options. So a lot of the difference between those two ties to what you expect going forward. So the loan option has, we think, a much higher likelihood of repayment. Those payments won't start till 2021. Hopefully, folks are fully back at work by then and have a regular paycheck that they can make those automatic loan repayments. There's going to be interest attached to that, just like a standard loan. Most plans have repayments through payroll, so a very set repayment schedule, and we expect that that'll drive a higher likelihood of repayment. Now, on the flip side, if someone takes a CARES loan and then ultimately defaults on that loan in 2021 or a future year, the remaining amount outstanding is going to be taxable at income tax rates in that year, plus that early withdrawal penalty. So, to the extent that there is concern about the ability to make that future repayment and future employment, the CARES withdrawal definitely avoids that early withdrawal penalty. And certainly there's the option for repayment there as well, but I think we have to recognize the likelihood of repayment of those withdrawals is much lower than it probably is with the loan.
And you may have already hit upon this, but I just want to clarify, could an employer choose to offer one and not the other? And if so,
Mhm.
are you seeing organizations kind of weigh Yeah, I would rather do the loans because that has a higher likelihood of repayment, or are saying we're either going to do all or nothing.
Yep. So you don't have to offer either option. You could offer one, you could offer both, you could offer neither. There's a lot of flexibility there. We have seen our clients and employers taking all of those potential routes. I will say for companies that are looking to just offer one option, most generally in an effort to simplify the messaging, generally they are choosing the withdrawal. Given the existence of the penalties in the event of the future loan default, that withdrawal definitely avoids the penalties, so less onerous to an employee if it's not going to be repaid to the plan.
Mm-hmm.
We have had some clients, to your point, that generally feel that they have less impact on their employee bases, that have had a preference for the loan. But a lot of those organizations are offering both features and then looking to communication as a way to encourage, if you will, employees to look at that loan option.
A big responsibility for these plan sponsors is their fiduciary responsibility. Can you
Mhm.
talk about what that fiduciary responsibility is, vis-a-vis the CARES Act, and
Mhm.
why employers should be concerned about their fiduciary responsibility?
Yeah, or maybe not super concerned here. I think it's important to remember, especially in situations like this, these are plan provisions, which means deciding to offer these features or not is not a fiduciary decision. It's a settler function or a decision that you're making as a business leader, not as a fiduciary. So the fiduciary responsibilities of acting in participant best interest, avoiding conflicts of interest, all of those fiduciary standards don't have to be applied here. But it's always good to think through those things, and where the fiduciary responsibility does kick in, once you have decided what features you're going to add, there is a fiduciary responsibility to administer those in accordance with the law, and then ultimately to amend the plan document to reflect these features. Congress was nice enough to give you until the end of 2022 to get that formal plan amendment in place. So you can put that on a future to do list and not worry about it here in the near term, but that will need to happen at some point.
So you mentioned just a little bit ago considering your culture. And this, I think, communication has been so key throughout this pandemic, with regard to employee communications and maintaining culture. How do you recommend that organizations, fiduciaries, HR professionals, how do they communicate these decisions that they're making in a way to their employees that helps employees understand, and know where to turn for assistance? Are you helping employers with that? Are there other resources available? How best to make sure communications are clear, strong, and also match to an organization's typical communication style, tone, medium?
Mhm. Yeah.
What do you think?
So, unfortunately, I think a lot of retirement plan communications get so bogged down in the legalese and the compliance requirements that they become almost indecipherable to employees. Fortunately, for these features, you have a lot of flexibility about when and how you communicate them. There's actually no requirement to communicate them this year. So, one strategy that some clients are taking, especially if they don't have widespread impact, but would like to be flexible for their employees, is adding these features and not sending out any communication. As you step up from there, you could consider strategies like general retirement plan communications, perhaps a communication that talks about market volatility, the importance of saving, and referencing that, in the event of financial issues, you might consider a withdrawal and to contact your administrator to learn more, being able to put out some information without really blasting out there that, hey, you can get money out of the plan. Of course, organizations that are going through more significant workforce changes are choosing to include very specific information, generally with other layoff and furlough communications. And we're seeing them keep it very fact based, having clear and straightforward descriptions of what the impact of the withdrawal is, both on taxes and potential for repayment, and very specific instructions on how to contact the plan administrator to take that withdrawal. So there's a lot of options available out there. We will be working to put some sample communication materials together that we'd be happy to share with the HR source members.
Thank you. That would be really helpful.
Mhm.
So I think we already covered this, but if an organization's deciding to not opt in, um, no need to do anything at the time being, just to stay abreast of what the options are and to be, I would say, knowledgeable and articulate, or is there some sort of
Mhm.
paperwork or some communication that needs to occur
Mhm.
with their plan administrator?
Yeah, it totally varies based on plan administrator. Some administrators are using an opt out process, which means they are going to add these features to the plan unless clients tell them no. So we think the best possible outcome for you is to contact your plan administrator and just tell them what you want to do. If you want to add the features, if you don't want to add the features, and then they'll let you know if they need specific paperwork. Some administrators have created a form, others are just accepting direction via email. So there's a lot of processes out there, but communication is key here. So communicating your intentions and seeking confirmation that your administrator has received that election will ensure that what you want to occur is actually processed in your plan.
I know I'm asking you to guess, but there's so many of these Q&As on TV now where they're asking tough
Mhm.
questions. So I feel like I should throw a few
I'm
zingers in
ready.
there. Hopefully this will be easy for you. But would your guess be that most organizations have heard from their plan administrator by now? Or is it like several of the other issues that are happening that organizations
Mhm.
are so backed up that they're not quite ready to send out mass
Mhm.
communication? So like, should HR professionals, should plan administrators, should fiduciaries be reaching out if they haven't heard, or should they hang tight and
Mhm.
not bombard um, their trusted partners at this time? What would be your recommendation?
Yeah, I would say most, but not all administrators have put their processes in place at this point and have started to communicate those to clients. If you haven't heard yet, I don't think it's at all inappropriate to reach out. Fully recognizing everyone is getting so much email right now, it's very easy to overlook or miss something. So your administrator can always tell you that they're not ready yet, but at a minimum they should be able to offer you some information at this point as to when, if not already, they expect to have that information for you.
Great, thanks. So, what if an employee already has a loan outstanding? How will that play into these new provisions?
Sure. So, two ways. First, again, if they're impacted by the virus and already have a loan outstanding, they can request to delay their 2020 loan repayments. So, no more repayments in 2020, move those out a year. If you would like to offer this special CARES loan, but you have people who are impacted by the virus that may already have a loan outstanding, you may need to or could want to offer a second loan if your plan doesn't already do so, or even a third loan specifically for this purpose. So, if the plan would otherwise not allow multiple loans, letting somebody take this special CARES loan on top of an existing loan.
Okay, so let's go back for a second to the hardship withdrawals.
Mhm.
If an employee is impacted personally by COVID-19, how does that play out?
Sure. So, a question we have been getting a lot is, well, my plan offers hardship withdrawals, so do I need to add this CARES withdrawal, which is kind of a special hardship? And the answer is no, you don't have to, but it probably is a good idea. While somebody may be able to access a standard hardship, first and foremost, it's going to be more punitive than the CARES withdrawal because that early withdrawal penalty and taxes will apply for 2020. Hardship withdrawals are also more restrictive in that somebody has to have a demonstrated need and either prove that or self certify to that. There are a couple demonstrated needs that may come into play in the current environment. Top of mind would be paying medical expenses for yourself, dependent, or spouse, funeral expenses for a dependent or spouse, payments to prevent eviction or foreclosure. Those are all standard hardship provisions. So, if one of those situations is happening, somebody may qualify under a standard hardship, but again, it's going to be a more punitive withdrawal than the special cares withdrawal.
Good. I know a lot of plans, including HR sources, has former employees still
Mhm.
with funds in it. How do these different options impact those former employees who are still part of the plan?
Sure. So, former employees can potentially use these options, but also former employees generally have the ability to withdraw their funds from the plan at any time. So, a former employee could take a regular withdrawal, roll that to an IRA. The CARES withdrawal can be taken from an IRA. So, an individual could do that whether or not you choose to offer the CARES provisions in the plan. They could also take the CARES withdrawal from the plan and then repay that to the plan or to an IRA. They've got that flexibility. Probably no loan option available. Most plans don't let former employees take loans out. So the withdrawal options would really be the key focus. So ultimately, former employees, they've got more flexibility. Really, these provisions are intended for current employees who don't otherwise have the ability to take money out of the plan.
Got it. So, we've covered a lot of territory, but I'm wondering if there are other changes that organizations should be thinking about right now. If they're already in looking at plan provisions,
Mhm.
thinking about what they're offering, thinking about communications with their team members and or former employees, are there other things they should be looking at right now, reviewing, considering while this is top of mind?
Yeah, the other kind of potential changes that we're getting questions on are generally around company contributions for organizations that are experiencing financial difficulties on the organizational side. Certainly, considering reducing or freezing company contributions in the short term is a strategy on the table. And the biggest thing to keep in mind there is if your plan uses a safe harbor design, then you do have to give advance notice in order to freeze those contributions. Generally, that's 30 days advance notice, but you should check your own plan document and your own safe harbor notice. But just most important to know, you may need to plan ahead there. Discretionary contributions can be frozen at any time. So, a lot of organizations are assessing their options of how to manage costs in this environment. The other potential element to keep an eye on if you are going through furloughs and layoffs is the potential to trigger a partial plan termination. If you hit certain thresholds with respect to the amount of your workforce impacted, you could trigger that official designation. And the impact of that would be the requirement to accelerate vesting on any unvested contributions in your plan. So, again, something to keep an eye on and keep tabs on throughout the year.
This is slightly outside of the scope of our discussion this morning, but something I'm sure you're getting questions on. People are very concerned about their 401ks, their 403bs. They're looking at their balances,
Hmm.
mostly declining, and they're
Mhm.
considering changes. Any guidance, again, for the HR, the plan sponsor, CFO, leaders in terms of employees reaching out? And, certainly we can sympathize with them, empathize with them, but
Yeah.
any guidance you want to remind employers about areas to be concerned about, things we can say, can't say? I
Mhm.
think this is an issue that um, occasionally, we get questions from employees that are beyond the scope of what we should be responding to. And so just thought it would be a good time for a little refresher on
Sure.
making sure we stay within the guidelines in that arena.
Yeah. So the biggest item is around advice. Can't give advice or tell people what they should do. So, unfortunately, I think a question that comes up from individuals a lot is, "What should I do?" The market is falling, and we can't say, "Well, this is what you should do." But we can encourage certain strategies and remind people of important investing tips. So, encouraging employees to maintain a long term focus, reminding individuals that market volatility does happen. It's easy for employees to forget that declines in the stock market are actually somewhat normal. We've had such significant market increases in the last 10 years. I think a lot of folks forget that actually in the average year, the stock market falls by at least 10% at some point. And yet, in the average year, the stock market has still moved higher by 10% per year every year since the 80s. So, market volatility does happen. Another important reminder is to not try to time the market. Oftentimes, the best market performance days immediately follow the worst days. We've seen some of that already. So sometimes we'll hear from individuals, maybe I should just, move my money to cash for a little while, and then after things are clearly getting better, then I'll get back in the market. And that's a really damaging potential strategy and missing out on some of those best days. And then lastly, I would say always direct them back to your plan administrator if they have questions. Administrators have been doing a pretty good job of putting out collateral about market volatility, having messaging on their website, or individuals in the call center that can talk to employees who are just afraid and just need to have a conversation to be reminded of that time horizon and the impact of volatility in the short term versus the long term.
Wow, those are such great tips, not just for today's times, but for investing in any kind of market environment. So thank you so much, Allison, for shedding light on these really complicated issues. Certainly, it's going to be clear to the viewers from HR Source, our members, why we turn to STRAT for our guidance, advice, and counsel. We highly appreciate the partnership we have with your organization and the expertise that we know we can rely upon. So thank you for taking the time to spend with me and help our members learn more about these complicated provisions of the CARES Act. Thanks
Absolutely.
again.
Thank you for
having
me.
And again, members, turn to us, turn to STRAT. We're here to help you. If any of the questions you continue to have weren't answered today, we stand ready to provide you resources, guidance, support to get you through these times.